We believe it was, and even irrational. People were convinced that the Fed would keep tightening and send us into recession, thought that the slowdown in China would spread to the U.S., and now those fears are subsiding. In addition, value is guiding us as well. We still see stocks as 3 to 4% below fair value. Value's growing, so we think the market can move higher.
And Brian, what about you? How much of a tailwind does this bull market have?
I think it's got a very big tailwind. We had a panic in 2015 and 16 that launched 2 years of debt-fueled buybacks, mergers, and LBOs. I think we're going to have the same thing, another couple of years of debt-fueled buybacks, mergers, and LBOs because of the panic that we had at the end of last year.
And why LBOs in particular, Brian? Why are you focused on that piece of the market?
One of the fastest growing areas of the financial markets is the private markets, private equity and private debt. There's a lot of headwinds to being public. It's notwithstanding Uber and Lyft coming public. It's very difficult to be a public company if you're a CEO. You've got these regulations you have to deal with. You have short sellers you have to deal with, whereas you can get a higher valuation in the private markets, and that's where the investors are going as well. So companies are tending to follow the investors.
Yeah, and Craig, that's why I take it as good news that we have these big name IPOs coming, even if it's a little late in the game. Let me just ask you both about something Janet Yellen flagged earlier this week. Corporate debt, she said in a keynote discussion that I do think non-financial corporations have run up really quite a lot of debt. What I would worry about is if the economy encounters a downturn, we could see a good deal of corporate distress. And I think that's something that could make the next recession a deeper recession. Craig, what would you say to that?
I just don't see it. The debt-to-equity ratio for the S&P 500 companies a decade ago was 2.2. Today it's 1.1, so they've reduced their debt usage in half. Their debt-to-asset ratio was 38% back a decade ago. Today it's 25%. Same thing for mid-caps and small caps, so I just don't see a debt problem.
Brian, do you? Because you did mention things like leverage buyouts.
In the private sector, in private debt and private equity, the debt ratios are worse than in the public sector, so I think there's more of a problem there. But this is like 1995 when the Fed worried about that. We had another 6 years of strong debt growth, strong private valuation growth after the Fed began to worry about it. So we're probably going to have another 5 to 6 more years of additional debt, even though the Fed's worried about how much debt there is right now.
Brian, do you think the Fed should be tightening, doing more here in order to make sure that we don't end in some kind of frenzy like we did in '99 and like we did in 07, 08?
If you look at what financing investors are saying, which are much more important than I am, because that's where we price short maturity corporate debt, they're telling the Fed to cut for the next couple of years because they're seeing economic weakness. They're seeing deflation worries, especially with this Amazon news coming out with a new grocery store chain. So they're telling the Fed to cut. The Eurodollar curve, which is where we price debt off of, is inverted right now. That was positively sloped in the summer. We went from telling the Fed to raise rates to telling the Fed to cut rates.
And Craig, what would you tell the Fed, or what do you expect of them here?
We believe neutral policy is when the risk-free rate, say Treasury bills, equals inflation. And right now inflation's about 2 and T-bills are near 2.5. So in our mind, the Fed already went too far. It's not tight enough to hurt anything, but it's still slightly to the tight side.